All right, let's dive right into a really provocative idea from Colin Bennett's book, Trading Volatility. The title of Chapter 3 makes a super bold claim. Pretty much everything we think we know about market volatility is just plain wrong. So let's find out why.
So here's the big question, right? The one we're really going to dig into today. A lot of folks think that buying volatility, betting on big market swings, is a really smart way to protect your portfolio. But what if that idea isn't just a little bit off, but actually fundamentally flawed?
We're going to start with the core argument of the whole chapter. What you think you know is wrong. We're going to explore why the market's so-called fear gauge can be super misleading, and, get this, how the very act of trying to protect yourself can sometimes create the exact chaos you're trying to avoid.
This quote from Colin Bennett gets right to the heart of it. What he's saying is that the market consistently, and I mean consistently, overestimates how wild future swings are going to be. Put it another way, investors are always paying this extra fear premium for what-if scenarios, and believe me, that cost really adds up over time. And that leads us straight to the first big myth we need to bust. This whole idea that you can just buy some simple portfolio insurance by being long volatility. It sounds fantastic in theory, right? But the reality, well, it's a whole lot messier. Okay, to really get what's going on, we need to be crystal clear on two key terms. On one side, you've got implied volatility. Think of that as the market's guess. It's the price you pay for protection against future swings. And on the other side, there's realized volatility. That's what actually ends up happening. The gap between that prediction and the reality, well, that's where this whole myth starts to fall apart. This right here is the idea so many investors have. You buy some protection, right, an umbrella for a rainy day, and when that market storm finally hits, it's supposed to pay out and save your portfolio. It's a really simple, comforting, and honestly a very appealing idea. But here's the catch, and it's a big one. Like we saw in that first quote, this insurance is almost always priced way too high. You're constantly paying a premium for a worst-case scenario that, on average, just doesn't happen as bad as the market fears. And over time, all those little premium payments can seriously drain your returns. And this chart from the book makes that cost impossible to ignore. See that red line? That's the average profit from holding volatility as insurance. You'll notice it's pretty much always below zero. And here's the crucial takeaway. Yeah, it might save your skin in a rare, sudden crash, but the slow, steady bleed from paying that premium makes it a losing strategy in the long run. Okay, this brings us to the most fascinating and, frankly, kinda scary part of this whole thing. What if the very tools that are designed to manage risk could actually amplify it and turn it into a full-blown crisis? Let's break down this crazy feedback loop. Now, we're not talking about small-time investors here. We're talking about massive institutions, the big players that sell really complex financial products. It's their hedging activities, which are often totally automated, that can set off this incredibly dangerous chain reaction. So it all starts with something simple. A market drop. Nothing out of the ordinary. Just a regular downturn. But this is the trigger. Okay, now here's where it gets really weird. As the market falls, some of the complex products these institutions have sold start to behave in a really counterintuitive way. The math behind them basically flips their risk profile, and all of a sudden, these institutions find themselves betting against market swings. They become short volatility, and that is a hugely risky position they need to get out of like yesterday. So how do they fix this mess? They have to hedge this new risk that they never wanted in the first place. And they do that by rushing into the market to buy volatility, usually in absolutely enormous amounts. This isn't some strategic choice they're making. It's a forced, mechanical reaction just to get their books back in balance. And this right here is the feedback loop. This huge wave of forced buying, it pushes the price of volatility way up. But as volatility spikes, guess what happens? Their original positions get even riskier, which then forces them to buy even more volatility to cover themselves. The hedging makes the problem worse, which requires more hedging. You see where this is going? It's a spiral. So when you look at the full cycle, you can finally see how a simple little market dip can get amplified by all this automated hedging into a massive volatility event. It's like there's this hidden engine inside the market that can just manufacture its own panic. But why does this even happen? Well, it really boils down to that classic conflict. You've got the neat, tidy, perfect world of financial models on one hand, and the messy, unpredictable, chaotic reality of the actual market on the other. You know, the foundational models of finance, like the super famous Black-Scholes model, they work based on some really convenient assumptions. Like they assume we know exactly how volatile a stock is going to be and that we can trade nonstop without any friction. It's a beautiful theory, really. But reality, well, reality looks a lot different. On the left, you see the theory, a perfect, predictable profit and loss line. But on the right, that's the real world. Here we've got two stock paths that start and end at the exact same price. But the path they took to get there, one just kind of hovered around the starting point, while the other took a massive nosedive. Results in completely different outcomes for a trader. The journey really, really matters, not just the destination.
So let's just quickly recap what we've figured out. First, the market's fear gauge is consistently overpriced. Second, because of that, buying volatility as insurance is basically a losing game over the long haul. Third, there's this dangerous feedback loop out there where the very act of hedging can create more volatility. And finally, the real market behaves absolutely nothing like the clean models you read about in a textbook. And that really leaves us with one final and, I think, crucial question. If something as basic as hedging can actually have the exact opposite effect of what it's supposed to do, it really forces you to wonder what other core assumptions that we make about the market might be built on shakier ground than we think. That's definitely something to chew on. Thanks for watching.